So once again, thank you everyone for being here. So the purpose of today's presentation is really to give you a basic understanding of commercial financing, particularly for our investment community. So for those people who don't know me, my name is Kai. I'm a mortgage broker, and I'm also your real estate investment financing specialist. So my focus is on commercial financing. I also offer residential mortgages. I use a mixture of both to offer you more options and also more solutions. So if you're buying commercial property, or if you're doing flipping, bursts, doing conversions, or simply setting up a rental portfolio with either residential property or commercial properties, I can definitely take a look and offer you some potential solutions. Now, if you and I will ever get a chance to work together as a team, I'll provide you with all the tools and also connecting you to other professionals if needed.
That's awesome.
Yeah. So I'd like to start with the common challenges that our investor community is facing, and how commercial financing might be able to offer you some potential solutions. So one of the questions I get most often is, what kind of financing option do I have to buy my 11th rental property? Because after your 10th residential property, a lot of residentials will kind of shy away and refuse to give you the financing, because technically you're doing this with a business purpose to it. But if you're buying your 11th residential property, or your 15th or 25th, commercial financing, commercial lenders, we're okay with this, and we can potentially look into a file and offer you some options. Also, some investors, they do decide to get into commercial investing. For example, some people want to buy industrial warehouses, or some medical doctors want to buy medical offices. So if you're buying a commercial property, then you definitely need the commercial financing. Another question I get very often is, how can I make the mortgage disappear from my personal credit bureau? This question mostly comes from people who have substantial equity in their primary residence. They're trying to refinance it, but they also have some mortgages they have on their investment properties. Now, on the residential side, because the mortgages on the investment properties are still going to be calculated toward the debt servicing, that really jeopardize their ability to refinance the maximum amount of equity out on their own occupied home. But with commercial financing, we can potentially offer you some potential solutions, and we'll dive deeper into the details later on in the slides. Another challenge, another scenario is really people trying to buy properties when they have a low or no personal income. This can be potentially done with the commercial financing too. So first off, I'd like to let you know there are some differences between residential mortgages versus commercial mortgages. On the residential side, the mortgages are qualified based on income and also credit, whereas on the commercial side, everything is mostly based on net operating income and also debt coverage ratios. If you have a business and you're buying a property for yourself, then the lender's definitely going to look into the business plan. Or if you are buying a property as an investment, the lender will still want to know what is your project plan. And also your net worth is also one of the factors the lenders take a look at. Some of the lenders, they have a hard requirement. You do need a 25% of the mortgage amount as a net worth to qualify for the mortgage. So simple numbers, let's say you're requesting a loan amount of 1 million. Some lenders, not all, they will require you to have 250,000 as in net worth. That can be real estate equity to qualify for the mortgage.
John is asking, what is DCR?
Yeah, I'll just talk about that. So for those of you who are newer to commercial financing, one of the most fundamental concepts is net operating income, NOI. Now, net operating income is really gross revenue minus operating expenses. Please note, I didn't say gross rent, because if you have a commercial property, for example, you have a multi-residential, on top of rents, you can also charge parking income, laundry income. You can even put a vending machine in there, claim that as income too. And if your property is in a really good location, and you can potentially put a billboard on top of your roof, you can charge advertising fees too, and that can be recognized as revenue. So net operating income is really all the gross revenue minus the operating expenses. So I do have a post up on my Instagram for those people who prefer to read. If you like to, if you prefer watching or listening, I also have a TikTok video on my Instagram too. You can go and visit and get all the information. Now DCR, John, you were asking what DCR is. So DCR stands for debt coverage ratios. It's calculated using net operating income divided by loan payments. So for example, if your monthly mortgage payment is $10,000 and you have a net operating income of $20,000, then your net operating income can cover your mortgage. That's what it means really by debt coverage, right? So your net operating income is going to cover your mortgage at 200% or 2.0. The stronger the DCR, the stronger the property, financially speaking. So there are also major difference between residential mortgages versus commercial mortgages. On the residential side, when you buy an investment property, usually the lenders will require you to put in a 20% down payment. And if you're buying a property for yourself, if the property is under 500,000, then you can potentially do 5% for the down payment and get CMHC insurance and buy the property. Now, on the commercial side, it's different. If you're buying property for investment purpose, it's usually 25% down payment minimum. And if you're buying this property for yourself, for your own business, 100% financing is possible. And some of the lenders, depends on the type of assets, 120% with acquisition plus renovation, even 120% loan to value is possible if you can debt service with your business income. The residential mortgages are really the cheapest source of funds. That's why it's harder to get. Commercial financing, the pricing is a little bit more expensive. Also, if we're going commercial, you will have to pay an application fee and also pay an annual review fee as well. So if you're looking for the cheapest source of funds, then definitely I would recommend you to stay with residential lenders. But if you're looking for more options, you don't want to use your personal income to qualify for the mortgage, then we can potentially try commercial. On the residential side, the maximum number of doors the lenders can give you, it's usually 10 properties. In the mortgage broker channel, usually we can finance up to 4 rental properties plus 1 owner-occupied home with the A lenders, and the rest can be potentially financed by the B lenders. But if you're thinking commercial, there's really unlimited doors you can acquire, and you can use commercial financing to buy residential as well as commercial. You can buy unlimited doors as long as you can service the debts. Another difference here is inter alia, commonly known as blanket mortgage, is not really allowed on the residential side. But on the commercial side, definitely we can look into inter alia mortgages. That's okay. Last but definitely not least is the VTB. I get a lot of questions about VTB. On the residential side, when you go to the lender and you tell them that down payment comes from VTB, instantly you're gonna get a decline because that's not really allowed for a down payment purpose. But on the commercial side, we can do it public. There's really nothing to hide. VTB can be considered with the VTB payment factored into the liability, and you can still service the debts. We can potentially do it too. There's no problem.
Wait, can we ask some questions? Yeah.
Yeah.
I was gonna say, so hearing all this, so this will help people, for example, like let's say going into commercial, it could help people that, for example, let's say don't have a traditional job and would have to, work with, like, let's say they would be making sure that the properties that they buy are actually, for example, making sure they cash flow, they're making the proper income, or like you said, like the commercial side, that obviously same thing, their business is cash flowing for them to get their mortgage. Is that right?
So you're asking, so are the lenders going to look at a cash flow? Is that what you're asking?
Sorry, say that again?
So are you asking me if the lenders will focus more on the cash flow? Is that what your question is?
Yeah, and and that mainly about that. It's not really about the person themselves, and it's more about the actual property or the commercial property.
The person is secondary. The lenders they focus more on net operating income and also DCR from the specific property. The sponsor, the person is secondary. But to answer your question, will the lender focus on the cash flow? Definitely, because residential lenders are income lenders, commercial lenders are cash flow lenders.
Awesome. Does anyone have any questions for Keith that they would like to have answered? You can feel free to unmute yourself if you do want to speak to him directly.
No question?
Going once.
Hey, Guy, it's Antonio here, and I had a quick question regarding commercial lending.
Sure.
My thinking is, I guess like for primary residence, really for people that I guess wouldn't have any income, say retirees and people that are retired, is there any way to, I guess, get a mortgage on that from the commercial end?
Primary residence it's not really applicable with commercial lenders because commercial lenders they are more interested in financing businesses, right?
Mm-hmm.
If this property is going to be owner occupied, then I would recommend you to stay with our residential lenders.
Gotcha.
Yeah.
Also, I guess you'd have to take into consideration, like, even though it's a primary residence, are they making any money? Because normally primary residence is just to live in, so it wouldn't even satisfy the criteria of, right, that it's making money, because it wouldn't.
I guess in my case, where I'm asking is it would make a bit of money, where it's like, I guess, in-law suites, or like maybe it's a duplex, maybe it's a triplex. Just asking, like, hypothetically.
Yeah, I understood the situation. We can potentially look into this kind of deals, but if the cash flow is really small from the secondary suites, then probably your loan to value is going to be either really low or that's probably going to be the case. The loan to value, if the lender's going to do it, the loan to value will become really low because
Gotcha.
they're cash flow lenders.
Gotcha. Okay.
Yeah,
that makes
and we
sense.
have to look at the cash flow, the net operating income from the secondary suite, and see how much of a mortgage they can give you if you can qualify.
Gotcha. Actually, one question that pops up to mind. What if, I guess, like this deal is packaged with, I guess, like other couple of deals that are, I guess, like investment properties? Would they lend on the package together, or would they just be lending on the rental properties?
So that's a very good question. That's what I mean by inter alia mortgage is okay. So if you are buying multiple residential properties as a combo, as a portfolio, as a business, right? So the lender's gonna underwrite each property separately to make sure it's gonna debt service. Now in some major urban centers such as GTA or even in Ottawa these days, the prices are very high and there's only so much rents you can charge. So definitely the DCR is gonna fall on the short end. What you can potentially do is you can buy a property somewhere else, let's say Sudbury, right? To kind of where the prices are lower and the rents are high, to kind of supplement the DCR. You can package these two properties as a combo and send it to the commercial lenders. We can consider this.
Gotcha. And Kai, the thing that I'm thinking about it with commercial lending is, how does this traditionally work? Because my thinking is like, okay, I buy a property, say I lock this up, and then I go like, okay, I don't know, my DCR or my NOI is, I feel like it's pretty good, but then I've already closed on this property. And then if I go to, I guess, like a commercial lender, would they just be like, oh, yes or no? And then what happens in the case where they go like, oh, your DCR or your NOI is not high enough?
So that's a very good question too, Antonio. So we have to look at your property, what kind of property it is, where it's situated, because different lenders in different areas use different calculation for vacancy as well as management. Some would use 3% for vacancy or 5% for management. Where a property in GTA, maybe we're going to use 1% for vacancy and 3% for management. So in your opinion, if your DCR is gonna satisfy their requirements, definitely let me know your reasoning. And what I'm gonna do is I'll go back to the lender and ask for their version of calculation to see if there's a common ground we can satisfy both sides.
Gotcha. So I guess the best way to do this with the least riskiest way would just be to, if we see a property, we come to you, Kai, and we go like, hey, Kai, would this be a property that one of the lenders or commercial lenders have an appetite for? And then you would get back to us. Is that correct?
That's the process, yeah. So
Okay.
Give me a call. I'm always happy to discuss your deal. Let me know what kind of projects you're getting into, what kind of property is. I run my first round of numbers, and I present to the lender and get a better idea and get back to you. That's the process. You're right.
Perfect. And I apologize for all the questions,
Oh, no,
but thank you.
no,
No, thank
appreciate
you
that.
so much for all your questions. I mean, they're questions that everyone else has in their head and aren't saying. So it's good that you asked the questions. You're the brave one.
Hi, Kai. I have a question on the rates. Usually you mention more expensive on the commercial side.
Yeah.
Usually what's the range? Like, is it 5 or 6 or 8?
I'll talk about that in details later on, but it's not going to be that expensive. Depends on what kind of assets you're acquiring. I'll talk about, that's a good question too. I'll talk about this later in the slides.
Okay, another one, does the stress test rules apply to investment property and commercial mortgages too? Stress
test, what do we use? We use a conservative, kind of like what do we call it? The stress test on the residential side. On the residential side, it's usually 4.79 or contract rate +2. We have a similar idea, but we don't have such a policy. However, we do stress test by using a conservative number on the rates to kind of qualify the borrower in case that the rate is going to jump higher.
So there is nothing that OSFI or someone looks after that proper stress test.
There's what, sorry?
Is there a OSFI or the financial regulator that asks for a particular stress test, or you do in your own house, in-house? I mean.
So there's really no specific regulation on the stress test because commercial financing is balance sheet lending. The lender uses their own money to give you the money, whereas residential, it's different. So we have to follow the regulations. Commercial, we have more flexibility considering the money is really the bank's own money. They get to decide if they have if they have appetite for the type of assets you're acquiring or how much appetite they have in you being a borrower. So the lenders do not really have such a regulation.
Okay, thank you.
No problem. Thank you very much. Yeah.
Nathan, would you like to ask your question on the mic? We'll give him a second if he wants to. Or else, yeah, okay, I'll ask. So he said that, I guess he's just making a comment about the VTB. So I guess I'll ask a question. Is for VTB, there's no way that you could do VTB in residential if you're using a residential mortgage, sorry.
Residential mortgage or VTB, usually the lenders will decline if you tell them that the equity portion comes from the VTB. But on the commercial side, we can consider this, no problem.
Okay, great.
Yeah.
Okay, so I think we can move on. I think everyone's ready for the next slide.
Yeah, definitely. I'm gonna move on. If you have a more specific question, definitely come back to me and I'll give you some ideas. Okay, so time to demystify. A lot of people think commercial mortgages are applicable only on commercial properties. That is not true. You can use commercial financing to buy residential properties too, and even recreational properties. If you're doing Airbnb with a business purpose to it, we can potentially look at this on the commercial side. I think Sri was asking how much the rate is going to be. Well, pricing, that's what we really call it. The pricing is going to be higher on the commercial side. but it's not going to be substantially higher. If you're buying a multi-residential or even mixed-use properties, some mixed-use properties can be insured by CMHC. If you do get CMHC insurance, these days there's a good chance you can get a rate under 2%, which is very amazing, right? If you're doing conventional financing, 25% down payment, 2 to 3% is also possible on residential properties if you're using commercial financing. And even on some of the commercial properties, 2 to 3% is possible too. So it's not significantly higher, depends on the overall strength. The other two are similar. People think you will need a lot of net worth to get a commercial loan or get a lot of business experience, or at least have a lot of business experience to qualify for a commercial mortgage. That is not true either. So net worth is one of the factors the lender look at, but it's not all. So for example, if you have a lot of fallback income, meaning after closing, you still have 500,000 in cash, to the lender, there's a lot of fallback income. Should any vacancy happen, any unexpected events happen, you have quite a bit of money to fall back on. So they're going to be less concerned about net worth, right? And similarly, it goes to business experience. If you buy a franchise, let's say a flagship hotel or motel even, obviously you're going to get support from the franchise. And business, you don't have, then in this case, you don't have to have 10 years of business experience in a specific sector. So these are the misunderstanding people have on commercial financing.
And I think Zareen has a question.
Yeah.
Zareen, do you want to come on the mic to ask your question? Or I think he said thanks, so maybe you did already. Yeah, I mean, it was related to interest rates, so I guess you answered it. Although you didn't talk about fixed mortgages and variable, so maybe you want to say a little bit about how that impact. Is there a difference between residential and commercial when it comes to fixed and variable?
Terms are similar. On commercial side, you can get variable rate as well as a fixed rate. That's not a problem. It's similar.
And Antonio, do you want to come back on to ask your question?
Yeah, thanks, Diana. Kai, my question was really just, I know you mentioned Airbnb that commercial lending does. I was wondering with, I guess, like student rentals right now, because I guess like there's not a whole bunch of students living on campus. If we were to buy student rentals and they were vacant, are there commercial lenders that will lend to them right now? And then also the follow-up to that is, I guess when COVID is over or before COVID, was there a big appetite for student rentals, or was this kind of, I guess, like a trickier situation?
You're asking all the good questions, Antonio. I really appreciate that. So student rental, even if it's going to be vacant upon possession, what we can do is we can use the market rents, or if you're asking for a higher loan to value, what the lenders might do depends on if the lender want to have this property tenanted or vacant. What we might be able to do is we might be able to get some potential tenants sign intent to lease that we can, and the lenders can look at intent to lease as a formal lease agreements too. In terms of their appetites, it really depends on the location of the property and how strong the local student rental market is. If it's a smaller town and there's not a lot of students or students have left, then their appetite is definitely going to decrease. Or if you have students, let's say close to University of Ottawa, then and the students are still active in that area, then there's no problem. Depends on the area too. Does that answer your question?
Yes, it does. Thank you, Kai.
My pleasure. Thank you very much.
And Sri, would you like to ask your question?
Yeah, basically on the amortization side, do they allow 30-year or even more amortization years?
Do they what, sorry?
The years of amortization, do they allow 30 years from beginning or? Well,
CMHC, if it's a CMHC financing, you can go up to 40 years. Depends on the property.
40 years. Oh, okay.
40 years, yeah.
Okay, that's good. And the other question I have for net worth calculation, does that include all the assets like primary residence of all the JV partners and their rental properties, RRSPs, TFSAs?
Yeah, financial assets as well as real estate equity. That's no problem.
Okay.
Yeah.
Thanks.
And Zareen also has a question. Zareen, I hope I'm pronouncing his name or her names properly. But saying in Toronto, where there's most basement suites are not legal, will commercial lenders lend to those and use income from both units to qualify? That's a good question.
That's a good question. Depends on if you have a separate entrance. If you have separate entrance, potentially yes.
And I guess if the leases are there, right? If the leases are there, would they allow it too?
If the leases are there, yeah, that back to what I just said, right? So it depends on if you have a separate entrance and if you have a plan to obtain a legal status, and with you having a lease agreement, that's definitely gonna help. If it's vacant as of right now, then can you find a tenant and sign an intent to lease, right? Because to the lenders, their concern is, can you fill up the vacancy?
Mm-hmm. And also, oh man, the question just slipped out of my mind. They'll come back. But so Zareen's doing a follow-up question. Can commercial do 40-year amortization on duplex, triplex?
That's gonna be tough. It's usually, this is a residential property, I would assume. Is that a residential property?
Yeah, a duplex, triplex would be considered residential. We'll
Okay,
assume
yeah,
it's residential, yeah.
That's right, sorry. Yeah, well, for these ones, usually we can do somewhere around like 20 to 30, I would probably say. Depends on the lender and also the location, also the condition of the property. I'll talk about that later on.
Okay, awesome. Lots of good questions that people have. I think it looks like we're good for now, so we can continue.
Okay, I'll move on. And if you guys have more specific questions, definitely let me know. Commercial financing, it does give you some additional solutions that the residential lenders won't be able to give you, but it does have its own limitations. So for example, some lenders will charge you a lender fee. And if you prefer to have somebody such as myself to arrange the financing, because the lenders don't pay us anything, we do have to charge a fee. On the fee side, you are looking at 2 to 3%. Depends on how complicated and how time consuming your application is going to be, but usually it's around the 2% to 3% range. As I previously mentioned, commercial lenders, we do have to charge an application fee. It's usually 250 to 0.5% of the loan amount. Now it depends on the loan amount. Annual review fee, this is a range as well. It's usually 250 to 0.25% of the loan amount, and we have to do it on an annual basis. So Zareen was asking me about amortization. That was a very good question. Depends on the condition of the property, and it depends on the condition of the property, because if we're gonna order appraisal and the appraisal comes back is showing us the remaining economic life of the property is shorter than 20 years, then you're not gonna get a 25-year amortization, right? Because the property is not gonna be there for another 25 years. So potentially, if you're buying commercial, we also have to order appraisal to determine the remaining economic life of the property. If it's older building, then potentially the lender's gonna come back with a short amortization. What that really means to you is if you're doing 25 years on your own due diligence, but if the lender come back with a 15 or 20-year amortization, your payments is gonna go higher. That will change your cash flow. So if you are specifically looking for cash flow from this particular deal, then it might be a different situation. However, if you run into a situation where the lender is giving you a short amortization, give me a call. We do have some potential solutions. We can work this out. Other expectation for you to have is commercial financing will always require appraisals. On the residential side, if your loan to value is low, you might be able to get away with not having the appraisal, but commercial side will always need the appraisal. And depends on the property, we might also have to order an environmental assessment. and also historical use of the property as well. If you have a environmental report from the previous owner and the historical use hasn't been changed, and there's really no dry cleaner or gas station nearby, we might be able to use the old environmental report. With commercial lending, it's higher legal fees as well. You need the 2 lawyers, one for yourself, one for the lender. It's very similar to a private mortgage in that sense. Because there are more reports, more documents involved, the lender also take more time to do their due diligence. That means it's going to be a longer process. So if you're looking to close something within 2 to 3 weeks, we probably have to go private first, then later on refinance you. This one, I want to emphasize, personal or corporate guarantee might be required, but it doesn't show up on your credit report. This one, I want to emphasize this because this can be a potential solution to the challenges we were talking about this earlier. So let me go back. So we were saying that somebody have a substantial equity in their primary residence, but they cannot really find a refinance and take the maximum amount of equity out, because the investment property mortgages are also showing up on their shoulder, and it's impacting their debt servicing ratios. With commercial financing, if you can get these mortgages to commercial financing, they're gonna disappear from your personal credit bureau, and that's gonna free up the rooms for you to refinance your own occupied home and get a maximum amount of equity out. So this can be a potential solution for you.
Should we go through some questions first?
Yeah, sure.
Oh, sorry. Yeah. So let me see. There's quite a few that went in. Let's Seer, I think. Seer, do you want to ask your question? Sri.
Yeah, thank you, Dan. Yeah, I was asking about the economic life of commercial property in the bank sense. Is it like 50 years or 100 years or something around that?
That's the lenders usually order appraisal, and the appraiser is going to give you the remaining economic life of the property. It's on.
No, I know the remaining economic life is based on the appraisal, but usually what's the life of the property?
Depends on the property, right? So if it's an older building, maybe it's not going to stand for. Maybe it's going to stand for another 15 years. Then the remaining is going to be 15 years. If it's a newer building, then definitely it depends on how the appraiser sees the property. 50 years can be possible.
Okay.
Yeah.
Thanks.
No problem.
Jazz also had a question. Do you want to come on, unmute yourself and ask your question, Jazz?
Jazz is on the desktop. He has no mic, probably.
Oh, okay. So his question is DCR based on 20, 30, 40-year amortization?
That we can change. So it really depends. If you're requesting a 30-year amortization, we can run the DCR based on 30-year amortization. So it really depends on what you want, right? So if you want 30-year amortization and get the best cash flow possible, we can request that and do the calculation based on your request.
Okay, perfect. And Antonio, do you want to come on and ask your questions?
Yeah. Thanks, Diana. And Kai, you let me know if I'm asking too many questions or if I should leave the questions to the end, because I feel like I keep interrupting you. But and I'm thinking maybe some of this is shown on like the later part of your presentations. But I guess my 3 questions I wanted to ask is, if I do let's say if I do a couple of commercial deals for student properties, and say I qualify for these and I'm lended to it, and then on the residential side I can still qualify for like 1 or 2 before these student properties. So if I get these student properties under a corporation and they lend to me commercially, will this affect my lending for residential properties under my personal name?
It's not going to affect your personal side because it doesn't show up on your credit bureau, and you're using a holding company or corporation, right? So you're doing this for a business purpose. Business and personal, these 2 are separate.
Gotcha. And then this might be more so of that's really good to hear too, and this might be probably more of a legal question, but I'm wondering if you would know the answer. But I'm just thinking about risk mitigations for, I guess, like if an appraisal comes in lower or something like that. So say if I picked up a property and I do this under a holdco or a corporation, and it doesn't close, will I personally be liable for this, or would it just be the corporation?
I think first off, you're gonna lose the deposit, right?
Yeah.
Yeah. So I think you are right. This is a more of a question for lawyers.
Yeah.
If you got-
Okay.
Yeah.
Thank you.
No problem. Thank you very much.
Anyone else have any other questions? Let me see. I think none in the comments. Feel free to unmute yourself if you have a question. If not, I'm going to ask mine. So I'm going to give you 3 seconds like always. Going once, going twice. Okay, it's mine, guys. So my question is, you were talking about, and it was specifically with Antonio's question about the student rentals. But I thought with related to that, I was thinking you were talking about depending on the area, there's some kind of analysis that needs to be done to present the information to the specific lender. How does that work for the people? Like, let's say, do you help them with that, or do you ask them to get certain amount? Like, I'm not sure. Like what is the population size of the city or something? Like, is there certain things that you ask for, or you kind of do some of the analysis yourself, or even just knowing what are the things we should pay attention to?
So if you send me an inquiry for a student rental deal, what I will do, I'll reach out to the local lenders first. Usually student rental, the lenders do want you to put in 35% for the down payment. And they have to look at the lease agreements, the length of the lease agreements, and how many students are still active in that specific area, and come back with their thoughts. So that's how it's gonna really go, because different situations I have to speak with the lenders first to see what their guidelines are like.
Okay, so then it would be, you would be telling us then, I need to know this, and this, or you may investigate it yourself.
Yeah, so for any of your potential deals, inquiries, let me know. I'll get back to you with a more clear picture on the financing side of things.
Is there any general things that, we should check or see before, like just in general for us to know that they're already going to be asking us for?
Yeah, student rental usually is 35% down payment.
Not even student rental, just in general of properties. And I'm talking about, because you know how you're saying, like, it seems like you have to do a bit of some analysis, right? Because this is like a business plan or a project plan. Like, is there anything in there specifically that needs to be presented to, let's say, you or the lender, that are generic things?
Generic. So you're asking generally what I'm looking for in the first round of due diligence with you?
Yeah.
Yeah. Okay. So first one, due diligence. I usually want you to send me the rent roll and also the income and also expense sheets. I want to see how strong this property is, and if the DCR is gonna meet the requirement, right? So by running the first round of numbers, if the DCR is like 0.5, then I will tell you probably don't even bother, or go back to the seller and challenge the asking price.
Mm-hmm.
So that's what we usually do with the buyers in the first round.
Okay.
You see how deep it is.
And then just for curiosity, if you're, let's say, going into commercial, and let's say like you're a doctor or something, so you're buying the property and doing the business, what does the business itself, like what general information do you need about the business itself to be able to do your full analysis?
The business, I want to see your financial statements for the past 2 to 3 years. I want to calculate your EBITDA income. EBITDA income is really for business buying owner-occupied commercial properties for yourself. This is EBITDA. Zareen probably know better. It's really income before interest, taxes, amortization, depreciation, because these are paper expenses. So I add them back on to see what kind of income you are actually getting. Now with a business, with the EBITDA income for a business, I'll go back to the lender and kind of get an idea how much they can really finance you for.
Okay, that's good.
Yeah, financial statements, I will need these ones.
And so what happens though if you're just starting your business?
They might be tough to finance. What we can potentially do is if you have a similar experience in the same line of work, we might be able to do projected income. Projected income, let's say you've been working with the hospital for the past 30 years. Now you are venturing on your own, setting up your own clinic. We might be able to forecast the income and use that.
Okay, so just more work needs to be done for sure.
Yeah, that's why a lot of mortgage brokers do not touch commercial. It's double the work and also double the difficulty. But to answer your question, if somebody's doing the business like in the first month, it might be tough for them to get financing.
Mm-hmm.
Yeah.
So they probably then go private first, I guess, to get their experience in, and then may move to commercial after a few years. Like, what is the strategies they do?
We can potentially use private money to help you bridge the gap, or you can keep renting if you want. Depends on which one makes more sense for you.
Oh,
right?
true. You still have the option of renting. That's true. I, for some
because-
reason, forgot about that.
Well, if you can own, there's no point to rent, right? But renting, if you're starting a brand new business, renting might also offer you some potential benefits, considering that you might be relocating a few years after, right? And you, as a new business owner, there's really no guarantee how well the business is gonna go. And if you end up owning a property, but somebody, if their business isn't doing as well as they expected, then there's really too much risk at this moment.
Yeah, which totally makes sense. And I think any person would probably want to make sure their business works first before they start getting a property for it.
Yeah.
So Susan, do you want to come on the mic and ask your question? I don't know if she's working. She might be working. But I'll give you a second if you want to come on, Susan. Oh, she can't. Yeah, she's working. So her question is, how do you get funding with a 60% VTB first position with commercial properties?
First position, VTB is not going to go on first position. The institutional lenders want to be in first position, but Susan, so if you're VTB, I'm gonna ask you the VTB, the interest rate, and use the monthly payment to calculate toward the debt servicing. With the VTB, if you can still debt service the institutional first mortgage, we can potentially consider this, but VTB is going to be in second position.
Okay, so it'd be pretty hard if same thing, that person that's VTBing only wants to be in first position, then they're kind of put in a situation, no VTB or because there's no lender at all will go into second position from a VTB?
Not institutional lenders. If the vendor is giving you 60% VTB, they want to be in first position, then maybe you and your business partners put in the rest 40% as equity.
Mm-hmm.
Then VTB is in first position, right?
But an institution would make, oh yeah, actually they don't go up to 80% anyways. What is it, 75? But they would go, let's say, to 75% behind the VTB? Or not even?
Okay. Say that again, sorry.
I was saying because her example is at 60%, and you're saying that for commercial they go up to 75, right?
Yeah.
So would you, let's say, be able to get up to 75% on a second with institutional?
Institutional, they don't really go on second position of the private lenders.
Oh, okay.
Yeah. But commercial lenders do have second mortgages. Institutional commercial lenders do have second mortgages. And on the commercial side, we call it subordinate debts or sub-debts. It's just a fancy name for second mortgages. So for example, if your first, I'm just giving you a random name. Let's say your first is with the RBC. RBC themselves can possibly arrange a second mortgage behind themselves, so that if you need more money, you don't have to refinance and pay the penalty. Just get them to give you a second.
Okay. So Susan is saying, so it's possible, but I don't think it, but you're saying, but it's not possible with VTB. It's only possible if it's with the same institution, basically.
Same with the institution. Can you guys clarify?
Because Susan's question was related to the VTB, but you're saying that with VTB it can't be in first position, like there's no way. But what you were saying just now is that if you do it with RBC, you can do with RBC a second mortgage. If your first is RBC, you can do the second with RBC. Is that was the example you're giving?
Yeah, that's the example I was giving.
And
So
that's the only possibility?
VTB can be in first position, but usually institution lenders will take the first position and put VTB on the second. So if your vendor is really particular that they want to be in first position, what we might be able to do is you or your business partners put in the rest 40% and put them in first position. Does that make sense?
Let's give her a minute. I think. So then, do you want to clarify then the RBC part? Because in the RBC, you were talking about there being a second mortgage and they were accepting it. Like, what's the difference between accepting the second mortgage, let's say, with RBC and the VTB?
Okay, so this is more of a question for second mortgages. So simple numbers, let's say you have a property worth 2 million and RBC has first position, they're sitting at 60% loan to value. They have a 1.2, right? And you're requesting some additional money, let's say another 200,000, right? So you have two options. You can either refinance the first and get a larger first mortgage, but in that case, you'll probably have to pay a penalty. Now, if the penalty is too high, what you might be able to do if you want to avoid it is you can ask RBC for a second mortgage. They will go behind themselves. So
but they just won't go behind another institution or another person like a VTB.
Most of the big five, they don't want to go after other lenders. There's a lender, it's called Roynet. It's a subsidiary of Scotia. They might be able to consider it, but their pricing is on the higher end.
Okay. So there is the possibility, it's just very, very limited.
For what, sorry?
Like your options are very limited for a second after a VTB.
Second after, so you want the VTB to be in first position?
Well, I think it sounds like it's like if it's not an option, where like let's say the person who's giving the VTB wants to be in first position, I think is her point.
The VTB can be in first position, but not before the institutional lenders.
Mm-hmm.
Yeah.
Yeah. So it's not possible then. Yeah. Okay.
Yeah.
Let me check. I think yeah. Sri had a question. Do you want to come back on, Sri?
Yeah. Thank you, Dan. Kai, you talked about EBITDA for the corporations for your DCR calculations, right? So I have a small consulting business, and all the revenue mostly I take it as a salary or some commissions and dividends. So in the net, I would have very small retained earnings. Okay. So in those cases, would you consider the gross revenue of the business?
We're going to calculate the EBITDA income. So we will need you to, I will need you to send me financial statements.
Okay.
Yeah. But it doesn't matter. We're going to add them back on anyway.
Okay.
Your dividends, your salary, your retained earning, we're going to add them back on.
I see. Thanks.
Yeah, because I don't think, because Sri, are you asking about what comes out of your corporation? Because the financials are what's happening within the corporation. So your corporation could be making a lot of money and it's just, you know, coming out, maybe you're not really paying yourself, for example, right? Is that what you're like getting at, Sri?
No, like for the calculations, what's the figure that they consider as, because after expenses, there won't be much in the small business that I run. So do they look for higher retained earnings from the corporation, or?
The higher the retained earning, the better, because to the lender, that's fallback income, right? If you're buying office for your own consulting business, should anything happen, at least you have the retained earning that can weather the storm.
Right.
So the more retained earning you have, the better.
Okay.
Okay, awesome. Everyone had some really good questions. This was a really good session. I hope everyone got a lot of value from everything that Key said. I know I did. So thanks so much, Key. It was awesome having you. And so if anyone wants to get in contact with you, where can they go?
So if you guys have any specific questions, please feel free to contact me. Calling me is usually the easiest. I'll get back to you usually within 2 hours. Or if you want to revisit the information, my stuff is also available on Instagram as well as Facebook. So please feel free to visit and get the information you want. So that's about it. Do we have other questions that you guys want me to go through?
Anyone have their last final question before we go?
I have a quick question, and my thing was really question would be like, I know you mentioned a lot of criterias and stuff, and really I guess like I saw one of your slides was also like a proposal. They also look at that. So I'm wondering if there's a good guideline or even an example of a package that you've seen work well with commercial lending that we can use as an example.
You can write up. I see what you mean. So you're asking me about the business plan, the project plan?
Yeah.
I can share you some ideas. Depends on what you want to do, right? And also if you buying this for yourself, or if this is going to be investment.
Mm-hmm.
But when you go to the lenders, you do need to give them an idea of what you want to do, what your plan is. Do I have a plan? I can share this with you offline. That's not a problem.
Gotcha. Okay. Thanks, Guy.
My pleasure.
Thank you, guys. And do you want to just share your show your contact information one more time? Rob's just asking.
Yeah, definitely.
Yeah, so there's his contact information. Hopefully, Rob, you can quickly get it before we end the session. But again, thank you, Key, for Kai. Sorry, my friend's name is Key Kai. for coming on. You gave lots of value information, and I know that everyone really got a lot of value from you. So thank you so much for coming on, and we'll see everyone on the next one. And just to also let you guys know, I'm having a networking event on April 29th. So if you guys are interested, it's going to be a lot of fun. We're going to be talking, we're going to have a speaking segment. It's going to be about mindset and performance. There'll be an hour, and then there's going to be the networking segment, and it's going to be one-on-one, 5-minute. So it's going to be like a speed dating kind of thing where you get to meet a lot of investors and just meet people. So I think it'll be a lot of fun. So if you guys are interested, you're going to start seeing more information about it probably on Mondays when we're going to start posting more information. So hope to see you guys at my networking event. It's going to be a lot of fun. You're going to get to meet a lot of people. So thank you everyone for coming on, and we'll see everyone at the next episode. Bye everyone.
Hey Diana, I just unmute myself just to say thank you Diana and thank you Kai for dropping the values, and I appreciate that.
Awesome. Thanks so much for coming on.